My next guest is a titan in the bond world and one of the first Wall Streeters to predict that Donald Trump would become the next U.S. president. I'm happy to welcome to the program right now DoubleLine Capital founder and CEO, Jeffrey Gundlach. Good to see you, Jeff. Thanks so much for joining us.
Nice to be here, Maria.
So you've got assets under management at a record, $116 billion. You've got to put that money to work amidst all of these questions. Let me ask you first about this whole idea about interest rates moving higher. Do you expect it in December?
Yes, I do, and the bond market expects it too. The Fed likes to talk about being data dependent, but the things that they seem most focused on are the level of the stock market and also the shape of the front part of the Treasury market. And from comparing the yield on, say, 1-month T-bills, 3-month T-bills, and 1-year T-bills, you can divine a probability that the bond market thinks that the Fed's going to raise rates. And the Fed never raises rates when that probability is less than 70%, and they basically always raise them when it's above 70. So you could pretty much replace the Fed with the Treasury market, and in essence, that's what's really happening. And the Treasury market certainly believes the Fed will raise rates. And I think the most recent inflation numbers, particularly on the core CPI, which came out, it was looking really weak for about 5 months in a row. And the last one that came out was at the level that the Fed wants to see it. And the PPI came out this week, and it was up 0.4 in the most recent months. Well, it annualizes to about 5%. And commodity prices have been rising. And GDP was pretty decent in the second quarter, and the guesses are for mid-twos or so in the third quarter, even with the hurricanes. So the Fed, I think, has basically a lot of momentum towards raising rates. We went from an environment where the Fed needed the data to get better to have the courage to raise rates. They kept sort of saying they were going to, and they didn't. Now, starting in about February, March of this year, the Fed shifted to a paradigm, well, they'll keep raising rates if the data doesn't get worse. So they're now kind of back almost in the old school mindset. You remember Alan Greenspan and Ben Bernanke? They used to raise rates at every meeting once they got into the mode. This Yellen Fed, they're a little more cautious, and they're raising rates kind of once a quarter when they feel like they're in the mode. Yeah. And that's where they are now.
Don't forget about the 2.9% wage move we saw, right, in that GDP number.
And revisions from the past numbers. You know, it was weird. The average hourly earnings were showing year-over-year change that was absolutely a flat line, and then they just got revised, and now it looks like they're in a rising trend again and up at 2.9. You know, with wage growth around 3%, I think the Fed will raise rates along with their program that they're advertising. The question really is what's the economy going to do in response to these two modes of tightening that have begun? We've raised rates 4 times. We're going to head to 5. The Fed wants to do 3 more next year, but there's another bug in the ointment, which is the balance sheet roll-off.
Yes.
Which there's a very cogent argument to be made that the quantitative easing helped the economy and certainly helped risk assets like the stock market. If you take the capitalization of the S&P 500 and divide it by the holdings of central banks, the ECB, the Bank of Japan, and the Fed, it's almost a constant. You can make the argument that the stock market has been propelled pretty nicely, and the global stock market too, by quantitative easing. Now, so one would have to think that maybe if that's taken away or reduced, it reduces some of that support.
Yeah.
And the Fed is now letting some of these bonds roll off. And we'll see what this double barrel of tightening financial conditions really does. So far, we have seen the yield curve in the United States, the relationship between short rates and long rates, has compressed from a very high number, say compare 2-year yields to 10-year yields. It was very high by historical standards before the Fed started tightening. Now it's kind of average. There is a theme that you hear a financial media report that the yield curve is somehow very flat and signaling recession. It's flatter than it was before, but it's actually at the 40-year average. And for really to be signaling economic trouble, you'd probably need the yield curve to compress quite a bit further, kind of towards flat. And we'll see if that happens with the Fed raising rates.
Well,
further.
certainly, you know, that jobs number with the 2.9% wage number, that was sort of one of the best parts of the report. But when you look at some other economic data, household income down, you know, sentiment, while it's up, people are not necessarily spending the way you would expect. So it is a little 2 steps forward, 1 step back. Do you think inflation is here?
Not really, no. The Fed keeps saying that they're perplexed, as you said at the outset, about why their inflation models don't work. There's this old thing about the Phillips curve, that when unemployment gets down to a certain level, inflation and wages are supposed to go up. But the unemployment rate has gone from 8 or 9%, 7, 8 years ago, to like 4.4, 4.3, or 4.2, I think it is now. 4.2 now, and wage growth has not really come back anywhere close to the model. One economist, I thought, had a clever saying. He said the Phillips curve flunked Econ 101 because it's not working. And that's what's so perplexing. But a lot of it has to do with, the way the economy has changed, the globalization, all of these things. Inflation isn't tipped towards the deflationary fear as much as it was before. Commodity prices are rising. Wages, as we said, are up 2.9. But we haven't been able to break up to 3-4% wage growth. And I don't think we're going to with the Fed putting on the brakes with raising interest rates.